Hey guys, Nathan here from Buyers Club. 2026 is already well underway and the Australian property market remains anything but uniform. Forecasts and headlines that we're seeing at the national level do point to really strong growth in the year ahead, but the reality is that performance will be driven by key local markets that have the right fundamentals. So, in this video, we'll be highlighting seven key markets across two categories that we're keeping a close eye on for the year ahead. Category one is three markets that are already hot, having performed at upwards of 10% growth in the past year, while category two includes another four markets that are emerging. Less than 10% growth in the past year, but really strong signs for the year ahead. Right, just move on to Murray Bridge first. First up is Murray Bridge, which is our first hot market, having recorded 11% growth in the past year, but still retaining exceptionally strong affordability. This is a smaller regional centre of just over 20,000 people, located about 1 hour east of Adelaide, which itself has been a relatively quiet but consistent performer in recent years. Prices in Murray Bridge, though, remain at about the 600K mark, despite values having doubled actually over the past 5 years with 107% growth. You can see in the price growth chart how, much like Adelaide, this was a market that was relatively subdued prior to 2022, before then entering a phase of very rapid and consistent uninterrupted growth with no major correction or slowdown so far. Just moving on to rental markets. Rental conditions in Murray Bridge remain very tight. Vacancy rates peaked at around 2% last year before falling back to below 1.5%, which does indicate renewed rental pressure moving into 2026. Median rents as well have continued a steady upward trend and now sit at around $450 per week, which reflects very firm tenant demand and limited available stock. Moving on to supply and demand. Inventory in Murray Bridge remains extremely tight as well, with less than 1 month of stock available based on current purchasing activity. Days on market are also holding at very low levels, averaging below 50 days, which points to sustained buyer demand rather than short-term volatility, especially looking at the trend here over the past year, holding very stable at a low level. Economic indicators now. In terms of population growth, Murray Bridge has broadly tracked South Australia as a whole, supporting steady underlying housing demand. Labour market conditions are particularly encouraging, though. Unemployment peaked at around 10% in 2020 before tightening substantially, briefly falling below the state average, but now sitting at approximately 4.5%. Overall, economic performance has stabilized as well following a period of contraction between 2018 and 2020, rebounding very sharply in 2021 and subsequently averaging out to a level roughly comparable with the rest of the state in the years since. Given the price point, though, affordability remains a really key strength for Murray Bridge heading into the rest of this year, particularly when combined with its proximity to Adelaide and commuter potential as well. Next is Southern Downs, which is admittedly a bit more of a surprise pick, but it has delivered very strong growth of over 15% in the past year, which puts it firmly among the top performing LGAs across the country from the past year. The Southern Downs region, for those unfamiliar, sits along Queensland's southern border, centred on the major centres of Warwick and Stanthorpe, and it occupies an important position within Queensland's regional economy. Despite the recent surge in growth, prices remain around $490,000, and values have now risen more than 120% in the past 5 years. Moving on to rental market. Rental conditions in Southern Downs are extremely tight as well, which is a bit of a pattern across the markets in this report. Vacancy rates have continued to contract and now sit at around 1.1%, pointing to persistent rental pressure across the region. Median rents as well have maintained a steady upward trajectory, which reflects really strong tenant demand. Moving on to supply and demand. Inventory levels remain lean, sitting at around 1.4 months of stock, with stock on market at just 0.2%. Similarly, housing supply has also failed to keep pace with new household formation in recent years, with only a minor oversupply in 2022. Days on market as well remain low for a regional LGA, as buyer demand clearly continues to absorb new listings quite quickly. Moving on to economic conditions. Population growth across Southern Downs. Sorry, I'll start again. Population growth across Southern Downs has remained steady, with annual increases actually accelerating since 2020. Economically, the region has been a really standout performer. Southern Downs has ranked among the top performing LGAs nationally for annual economic growth over the past 5 years. And in terms of annual growth, has vastly outperformed Queensland overall since 2021 as well. Moving on to Gosnells. Next up is Gosnells, which is our third and final hot market for this report. Gosnells has recorded just over 11% growth in the past year, putting it firmly in hot market territory, but still offering relative affordability within that Perth metro area. Gosnells sits within Perth's southeast growth corridor, about 20 kilometres from the CBD, and supports a population of more than 140,000 residents, which makes it one of the larger LGAs on this list. Typical prices are now around $800,000, which may sound high, but Gosnells actually remains the lowest priced LGA that's within 30 kilometres of Perth CBD. And that's been a key driver of sustained demand as buyers increasingly are priced out of other inner and middle ring markets around Perth. Moving on to rental market. Rental conditions in Gosnells remain tight. Again, vacancy rates sit at just over 2% and are trending lower, indicating ongoing rental absorption. And rents have continued to rise steadily as well, supported by population growth into the region. Moving on to supply and demand. Inventory remains constrained at around 1.4 months of stock, with stock on market sitting at just 0.3%. Days on market as well remain low at 30 days, which is really exceptional. And housing supply is a really big one for this market. It's been structurally undersupplied for an extended period now since around about 2017, which is a pattern that's only intensifying in recent years. Gosnells has demonstrated strong recent economic expansion as well, with local output rising by more than the Western Australian average over the past couple of years. Population growth has broadly tracked Western Australian averages, but is at a very high level across the board. And significant infrastructure investment, which includes the Metronet rail upgrades, key road projects, and some town centre renewal works, are improving connectivity, employment access, and ultimately long-term housing demand for the LGA. Next is Frankston, our first emerging market on the list, which has recorded over 8% growth in the past year and is showing signs of improving momentum heading into 2026. Frankston is one of Melbourne's most important LGAs, supporting a population of around 145,000 residents and more than 54,000 local jobs, which gives it substantial economic and demographic scale. Typical house prices now sit at around $1 million. So this is definitely more of a premium pick, but certainly a potential option for those who have more flexibility with their budget. Again, rental conditions in Frankston remain very firm. Vacancy rates sit at about 2.1% and are declining quite quickly. Rents have also continued to rise pretty steadily, and median rents are now at almost $600 a week. Moving on to supply and demand. Inventory in Frankston sits at around 1 month of stock, with stock on market also trending below long run averages. Days on market, again, exceptionally low for a metro LGA at about 20 days, which really reflects very strong and sustained buyer demand. While housing supply has also largely failed to keep pace with household formation in recent years, which really just drives home the tight conditions evident at the moment in Frankston. Population growth overall has lagged the state somewhat, but economic growth has notably been strong at times as well compared to Victoria as a whole. Next up is Wagga Wagga, our second emerging market, which has recorded about 5.5% growth in the past year, following a period of some consolidation after a pandemic surge that the market underwent recently. Wagga Wagga is one of New South Wales's major regional cities, supporting a population of about 69,000 residents. And it functions as a really key employment and economic hub for the broader Riverina region. Typical house prices at the moment sit at about $680,000, keeping Wagga Wagga highly affordable relative to some other regional and metro adjacent markets. Rental conditions in Wagga Wagga have tightened recently. Vacancy rates are coming back down. They're in a clear contraction and are moving quickly back towards a more balanced range. And rents have continued to climb higher as well over the past year. Inventory sits at over 1 month of stock, which points to a very tight level of available supply. Housing supply overall, though, relative to dwelling household formation, has admittedly been relatively high in recent years, but days on market are averaging at around 40 to 45 days, which is a very strong level. Across population growth, economic growth, and unemployment, Wagga Wagga has been quite well aligned with the state. There's a few periods of light overperformance in economic growth, for example, but a key factor for this market also is the defense presence, which really undergirds a very strong risk profile for this region. Blamey Barracks at Kapuka is a nationally critical training site for the army, and there is also the RAF base in Wagga Wagga, both of which support thousands of jobs and ensure that there will be baseline housing demand across the region for the long term. Furthermore, significant investment into these sites is planned, with billions already committed to be spent over the next decade on infrastructure upgrades relevant to these military bases. Next is Launceston, our third emerging market, which has recorded just over 5% growth in the past year. And this is a market that we've actually had a close eye on since early last year. So it's nice to see it starting to generate more attention at the moment, alongside Hobart and some other key markets in Tasmania. Launceston is northern Tasmania's primary economic hub and directly supports a population of about 70,000, but that's alongside a significantly larger regional catchment, which gives it really outsized economic importance within the state. Typical house prices at the moment remain around $670,000, which keeps Launceston attractively priced relative to many mainland regional cities and capital adjacent markets. Looking at the price chart as well, you can see that Launceston has recently reached a new high watermark or a new record price level, having just climbed out of this contraction that began in 2022. And often we see that when a market exceeds a previous record level following a contraction, that can signal a sharp uptick in momentum, which we are seeing now looking at the price momentum chart. Rental conditions in Launceston remain extremely tight. The vacancy rates sit at around 1.1% and continue to trend lower, reflecting persistent rental demand, while rents have also seen steady growth over the past year. Inventory in Launceston sits at around 1.3 months at the moment, indicating a very constrained level of available supply relative to current purchasing activity. Housing supply as well has been structurally tight in recent years, with recent dwelling construction increases so far insufficient to ease market pressure and the recent conditions visible across both sales and rental markets that we're observing. Labour market conditions in Launceston have improved in recent years, with unemployment now broadly comparable to the Tasmanian average. Having fallen from a level far higher than the rest of the state, unemployment had peaked at almost 9%, but is now in line with the state at closer to 4%. The region is also benefiting from really immense levels of infrastructure investment, around 7 to 7.5 billion across several key projects, which includes expansion of Launceston General Hospital, major university upgrades, the country's first AI factory data center, and a range of transport and freight upgrades, as well as a collection of renewable energy projects in the region too. Lost market. Finally, Ballarat rounds out our emerging markets list, having recorded just 7% growth in the past year. Ballarat is one of Victoria's largest regional cities, with a population now exceeding 120,000 people, and functions as a major employment hub west of Melbourne. Typical house prices now are at $550,000, which keeps Ballarat very affordable relative to Melbourne and potentially benefiting from strong commuter and lifestyle appeal as well. Looking at price momentum as well, we're seeing quite clearly that momentum is building as Ballarat, similar to Launceston, gets closer to hitting a new record price level following a contraction that began around 2023. Rental conditions in Ballarat remain high as well. Sorry, I need to start that, not high. Rental conditions in Ballarat remain tight as well. Vacancy rates sit at around 2% and are continuing to trend lower, while rental growth has been strong in the past year as well. Inventory in Ballarat sits at around 1.3 months of stock and is holding pretty steady there, while days on market is averaging out to around 40 days, also quite flat in terms of a trend, but sitting at a very healthy level. There has been admittedly a bit of an abundance of new supply in recent years, but this has just flipped back into undersupply as of the most recent data that we have. Ballarat has historically demonstrated a very favorable labour market, with unemployment often tracking below the Victorian average. The local economy is also doing well in terms of growth, mostly tracking, but often inching above state benchmarks for economic growth, as you can see, while population growth has also been remarkably stable at 2% roughly annually, avoiding some of the very large fluctuations that the rest of the state has experienced. Major infrastructure investment is planned as well, including the Ballarat Base Hospital redevelopment, continued expansion in the education sector, and a number of rail and transport upgrades, which will improve Melbourne commute potential. And that's continuing to support overall long-term employment and housing demand. And that's it. That was seven of the key markets that we'll be paying attention to throughout 2026. A bit of a diverse collection there across a range of states and price points, but that also just serves to emphasize how really localized conditions are increasingly something to pay attention to. And we've really flown through this list, but if you'd like to see the full breakdown, please feel free to reach out for a full copy of the report and let us know your thoughts on these markets as well. Are any of these particularly of interest to you? Do you agree or disagree? We'd love to get your take. Thank you for watching, though, and we'll see you in the next video. Thanks.